So you may recall in a video that I did quite recently, Treasury warns of tax rises to fill financial hole. Come the 17th of November, that's when the autumn statement will be announced by the now new Chancellor Jeremy Hunt and the government that they will raise taxation. And one of those taxations, or one of the taxes they will raise, is actually capital gains tax. I really do believe this is going to happen, and stay with me. Here's my rationale and justification for this. So in order to put forward my argument on this one, I'm going to refer to an article written in the accountingweb.co.uk by one Rebecca Cave, who interviewed Dan Needle of Tax Policy Associates. And in the article, it's very, very interesting. There's a bit of history, there's a paragraph on the history of capital gains tax. When it was introduced in April 1965, it came in at a flat rate of 30%, which is significantly, or then at that time was significantly lower than tax on income. And then that remained the case until 1988, when the then Chancellor under Margaret Thatcher's government, Chancellor Nigel Lawson, and I still remember him, equalised it with the taxpayer's highest marginal income rate. But what exactly does it mean by equalising capital gains tax rate to the highest marginal income tax rate? Well, stay with me on this one. I'm going to explain that using what's on screen. Here you can see tax thresholds, rates and codes for England and Northern Ireland for the 2022 to 23 year. So all of us in the UK, England and Northern Ireland, get an employee personal allowance of £12,570 per year. That's completely tax-free. Then the next 37,700 is subject to 20% on annual earnings. That is the basic tax rate. And then anything above that, 37,701 up to 150,000 is subject to the 40% rate. And then you've got the additional tax rate at 45%. So at the moment, capital gains tax rates are only at two rates, excluding residential property. So I'm just going to put that aside. And the rates are 10% for basic tax rate payers and 20% for higher and additional taxpayers. And don't forget, that is after you receive an annual capital gains allowance of £12,300 per individual. So only when you exceed that threshold do you kick in and pay 10% as a basic rate taxpayer and 20% as a higher or additional tax rate payer. And here's the crux here. So you can see it's 20% on your income, but 10% on your capital gains tax. And then if you're in this band, it's 40% or 45% on your income and only 20% on your capital gains. So they're not aligned. It's far more favorable for capital gains tax. So the whole argument is, or the possibility is, they could be equalized. So your capital gains tax rates could actually be brought in level with your income tax rates. So if we go back to the article, which was written by Rebecca Cave, it's actually estimated that such increases could raise around 8 billion for the Treasury, £8 billion. Now, again, if you go back to the video I did, fiscal black hole reaffirmed at around about 50 billion. So that's the hole the government has to plug in. And this would go a hell of a long way to plugging that in. And also, Dan Needle posed quite a few questions, which I'm going to sort of scroll down on here. Would a flat rate of CGT be the simplest option? And he goes on to say it's superficially attractive to impose a flat rate. However, HMR statistics reveal that half of the CGT collected here in the UK is paid by about 5,000 wealthy people. So you can see it's such a small concentration of people that are paying half the CGT. So he feels it would be more equitable to align CGT with the taxpayer's highest marginal rate of income tax. Now, this is a guy who's obviously a tax thinker, a think tank policy, whatever he is. The fact of the matter is, if he's thinking this, there's a chance that the government could be getting advised this as well. Another question that was asked is, would you also abolish the CGT annual exemption? And he responds by saying, I see no reason for retaining the full personal allowance of £12,570 plus the CGT annual exemption of £12,300. As we know, the £12,570 is for your income tax personal allowance. That's any tax from employment or self-employment, for example, gets captured by this allowance, and any capital gains gets captured by the £12,300. So I would merge these two allowances so that once the personal allowance has been used, all capital gains would become taxable. And in practice, most of us utilize our personal allowance very quickly with our income, and therefore, if we do have any capital gains, that they'll become fully taxable. And finally, the question I really want to point out that was asked is that various government ministers have claimed that high rates of CGT stifle business investment. Is this supported or borne out by research? And in his view, no. In fact, the IFS research has found that the current low CGT CBT rates, that's remember the 10% and the 20% rates, don't increase investment, but they do save plenty of tax for investors. So the argument there is, well, hang about, there's plenty of scope to increase it without damaging investment at all. So there you have it, a potential £8 billion tax grab through capital gains tax from the Chancellor and government come the autumn statement. What does it mean for us? Well, our capital gains could potentially double from 10 to 20% if you're a basic tax rate payer, or 20 to 40% if you're a higher or upper rate player. And there's some very, very valid arguments presented in this video, courtesy of the article from accountingweb.co.uk. And here's the final thought. If tax policy think tanks are actually writing and suggesting this stuff, I can assure you that governments are being presented this stuff as an option. So let's see what happens come November the 17th. As always, please like, subscribe, bell notification icon is useful. Till the next video, keep well.